This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Before I jump into my guest today, a little housekeeping. If you like this podcast, you can help. How can you help? You can help quite simply by going to iTunes. Real simple, covel.com/iTunes. Write a review. Reviews help. If you like this podcast and you write a review, it will push the show up higher in the rankings, which gives me more leverage to land great guests. I will even incentivize you. If you write a review, I will send you a CD and a DVD of some of my favorite trend following resources. Write a review on iTunes, send me an email. My email is real simple. My first name @mylastname.com. Today on the show, I have Vineer Bhansali. Vineer's with PIMCO. He's got a great white paper out called Trend Following Through the Rates Cycle. Now, PIMCO's been in the news a little bit in the last couple days. That's great. Not my concern, not my interest area. My interest area is the bond powerhouse, square in the middle of the trend following space. Not the academic momentum stuff on stocks only. No, PIMCO embracing classic diversified trend following as discussed in my books. Vineer's paper with his two colleagues at PIMCO is great. He also has an additional paper that we talk about in this podcast episode. And if you'd like a copy of that paper, you can go to my blog or you can send me an email. I hope you enjoy this conversation. There's two areas I want to talk with you today. I want to talk about the paper, Trend Following Through the Rate Cycle. And I also want to talk about the notes that you sent me about a presentation that you recently gave. Let's hold the presentation for the second part. My very first question I want to jump into, and I think my audience will be curious, when I see organizations, individuals start to write about trend following or momentum for the first time, sometimes it doesn't feel to me like the classic trend following CTAs that I've written about, for example. But right when I saw your paper, Trend Following Through the Rate Cycle, with your two colleagues, I mean, you guys are clearly talking about trend following in the classic sense. And what I'm really curious about, PIMCO, bond powerhouse, how did trend following start to become part of the discussion? Because clearly it's an alternate strategy. It's something different, but obviously you and your colleagues see something very beneficial there.
Right. So let me give you a little bit of history of this. So about maybe 7 or 8 years ago, I've been in the trading business for, close to 25 years now myself. And I've mostly been an exotic derivatives options trader and, traded a lot of fixed income and traded multi-asset portfolios, municipals, currencies, everything else on Wall Street and at PIMCO. And half of my career was spent as a proprietary trader. And the bottom line is that regardless of your favorite theory in the world, as a proprietary trader, you want to basically make money because that's how you get paid. And I was running a trend following program for myself almost 7 or 8 years ago, and it was completely hands off. I had basically outsourced all the rules, my rules, to a broker, and it did very well. And I was talking with a colleague of mine who was a very senior partner here, and I was mentioning, how we caught the trend a couple of times in 2000 and so on and so forth, and it was very hands off, almost effortless in terms of return to risk, with obviously a couple of drawdowns. And he suggested, you know what, you should have this as a PIMCO product. This was in 07, 08. So we started to talk internally about launching it as a product. Because PIMCO is a value shop and is a bond shop, this was a little bit of an outlier in terms of thinking process, in terms of a product. So what we decided, we got a lot of people involved to kick the tires, so to speak, to investigate it. And what we did was we said, look, let's run it as a private portfolio. So I put some of my own money in, and there was another seed investor, and I kept increasing to the degree allowed the money in it, and it did very well. It did the rules, which are very simple, and your audience and you are no real stranger to the rules and how they work. They're very simple. It's the usual, entry, exit, scaling, stop losses, et cetera, et cetera. But what we did was we really tried to structure it in terms of one, option theory. So our rules were very much a mapping of options, and that's where my own training came in. And secondly, we made it very aware of the nuances of fixed income, carry to be very specific, to really look at optimizing on carry. So we ran this portfolio for about 5 years, and I did reasonably well. And obviously, other people also got into this business, into the mutual fund or 40 Act trend following business. So we were a little late there. But last year we decided, given how good the performance had been and given how good of a diversifier the strategy was, we should really launch it as a mutual fund. So earlier this year, we launched it as a mutual fund. The ticker, if you care, is PQTIX. And, it's launched with some seed money and some retail money that's coming in. It's done very well. So it has become a pillar, I would say, of diversifying asset classes within PIMCO, and this kind of supplements or expands our offerings. We have been using the strategy for about 3 or 4 years in many of our multi-asset portfolios, where we believe that having momentum or trend following exposure is almost critical. To a certain degree, we've been using this as a supplement to tail risk hedging, which again, I know you all know about the fact that in a market crash, trend following does much better than mean reversion type of trade. So it's evolved, and it's found a very natural place within the PIMCO offering now.
Now, is the structure, the process at which new ideas can be introduced to PIMCO, obviously, given your success at bringing this to market, there was an ear. I mean, you're a very bright guy. You've been around the block. You've seen things. You know how things work. But introducing this to the rest of the corporate culture and then introducing it to your clients. Can you talk about both issues? And were there any issues introducing it to the corporate culture, or do people basically look at the data and they say, "Hey, we're data guys. This works"?
No, that's a great question. I think you're hitting the nail on exactly the two challenges. I call it the buy-in challenges that one has. So clients typically are easier because clients, most cases, registered investment advisors and other managers who see the value in momentum or momentum type risk factor, they've been obviously very receptive. For them, it's an interesting proposition coming from PIMCO because we're not a trend following hedge fund, and we don't have a very long track record offering certain products. Having said that, they are very receptive because they know that there's things about fixed income that we know that possibly not everybody else in the world knows, and that's part of the rates paper. I guess we can talk about that in a minute. In terms of the internal corporate culture, yes, it was a little bit of a shock when I've always been on the side of innovating or trying to innovate new products that expand PIMCO beyond just bonds. And we have a multi-asset strategy that has equities, that has tail risk hedging, that has momentum, and so on. So people were a little bit hesitant initially, and that's part of the reason why our incubation period for this product was 5 years. And even now, it's sometimes very hard to convince people that simple rules that take advantage of consistent structural, behavioral mispricing, whatever you want to call it, that results in trends, is something that you want to harvest. You don't want to put 100% of your portfolio in it, but this has a room, for appropriate amount of asset allocation. So I think the corporate culture has seen the performance, has adapted to it, and people are getting quite excited about these kind of offerings.
Well, you mentioned not a long track record yet for the trend following component. However, if we talk about your paper, Trend Following Through the Rate Cycle, and you can go ahead at the beginning and define the paper, at least for the audience, but you also go through, and I think it's hypothetical, but still, a trend following portfolio 1962 to 2014. So clearly you've looked at this going back on past data in probably innumerable ways.
Mm-hmm. Yeah, so we have, and we've seen all the really excellent literature that has come out of various competitors, as well as some of the speakers who've appeared on your show as well. Everybody finds some sort of persistent return to trend following. Now, what we did, and we is myself, Graham Renison, and Matt Dorston, is we went back and we created a data set according to a couple of rules starting in 1950s or 60s, and some of the data starts in 70 currencies, for example, because of Bretton Woods and so on. And we wanted to address three things in particular. One is this hypothesis that most people have, is that trend following is only a long bond or sell yields trade, meaning that when yields fall a lot like they have done from 1987 to now, things do well for the very simple reason that the discount factor that you use for discounting future cash flows all rise up, and the discount factors rise, all assets go up. So trend following should work only when rates are falling. So that was the first hypothesis. We wanted to test it with real data in a period of inflation and rising yields. So we had to go back and create a robust data series, from the 1950s. The second hypothesis that people have is that all the returns come mostly from bonds, and other asset classes don't really contribute very much. So that's kind of related to the first one, but we also wanted to test, how diversified trend following is over a very long period if you follow very simple rules. And then finally, and this is part of a research project that is ongoing, what is the trade-off between the trend part of a portfolio and the carry part of the portfolio, or the income that you get from holding positive carry positions? So that we wanted to test that as well. The most important one is the first hypothesis, that trend following only makes money when rates are falling. So we went back, we looked at the history, and what we found, very interestingly, and not too surprisingly, actually, and that's in the paper, is that yes, indeed, in the initial stages of rising rates, or when you go from falling rates to rising rates, trend following suffers because it has to get ready for the next trend, the emerging trend. But once the trend following model, and doesn't matter what your rules are, even the simplest rules to the most complex rules, once it adapts, then trend following actually makes money in rising rates environment. The corollary to that conclusion is that the carry that you might think will cost you money, because typically, if you're shorting bonds, let's say in a rising rate environment, it's a negative carry trade, that the carry will overwhelm whatever gains that you get from rates falling and markets rallying. Well, yes, that's true for a very short period of time, but for sustained trends, and in our paper we have 10 episodes that we painstakingly put together, we find that you actually end up making, in most cases, the negative carry back. So the momentum, if it's sustained for long enough, actually makes back the losses that you make from negative carry.
Let me interject something there too. I've known this for years, having looked at the data, at least the data that I've been privy to. But you're right. Currency trading has always been a huge, if not the largest, profit driver in trend following returns.
Yes. That's exactly right. And we agree. And we've seen that in the data from 1973 onwards. And I think what you're doing there is really touching on, the second empirical finding, and we have a theoretical framework or a model in which we can explain that as well, is that markets are interconnected. So if one market starts to make less attractive return, let's say the bond market, initial stages of rising rates, that doesn't necessarily mean that all other markets will also lag, because other markets can adapt much more quickly. So the currency markets, for example, will have more immediate returns. The equity markets will have more immediate returns. In many cases, commodity markets will also respond very, very quickly. So that kind of addresses the second point of the paper, which is that the returns cannot all be attributed to just direct interest rate falling exposure, because other markets also have some implicit exposure to the same factors that drive interest rates up and down. So if you think of those terms, then it's no surprise that the returns are actually quite diversified. And in a rising rate environment, and this is shown in a figure in our paper, in a rising rate environments, the other asset classes more than make up for the initial drag or initial losses that you get from fixed income, and currencies being a very important part of it.
One of the other issues, and I'm sure you looked at this as well too, but when you start to look at some of the smaller markets, some of the large, let's say CTAs and some of the large trend following shops have been around for a long time. They start to manage $10, $20 billion. They can't go into some of those smaller markets that do trend quite well. I mean, agricultures, for example. I mean, you start to get some limitations there set by the exchanges, frankly.
That's right. That's exactly right. And so what we've done is we've scaled our strategy. I think this is maybe a little bit different than what others do, is we've scaled our strategy to be somewhat significant at some future time in the context of how much PIMCO manages. So our strategy is scaled, and we thought about how we're going to grow it bigger as a mutual fund. So we've decided ex ante not to participate right from the very beginning in some of the very, very small markets where we believe that if you start scaling it up, to 10 times the size that we have right now, we won't be able to really get into the market and out of the market without incurring very, very high transactions costs.
Yeah. Really interesting stuff. Like I said, sometimes when I see some of the academic work or the marketing pieces from shops, I often see this talk of momentum, but it's never the classic. It's not often the classic trend following approach. And I know when I saw the David Shea note in your paper from Duke, that's what I also realized. I was like, okay, we're talking the same thing here. We're not just having a theoretical conversation about momentum on equities only. We're talking about trend following across a diversified portfolio. And so that was one of the reasons I really wanted to chat with you about it.
Great.
Yeah. Let me jump into something that you sent me that was kind of extra that I thought was really fascinating. And I guess, and you can describe it, but it was notes that you had used in a recent presentation. And I thought it was really interesting because here you are, a quant guy. And the way that I was reading it, and you can correct me if I'm wrong, but you wanted to connect your hobbies, and I want you to describe your hobbies. These are terribly, at least one of them is a hobby where I think most of us would just go, I'm not doing the 100-mile race. But anyways, you wanted to connect your hobbies to show how these many lessons that you can see, not necessarily only in trend following, but or you take it from the top. What are you trying to do with your 4 hobbies, and describe the 4 hobbies and why you thought it was so important to explain to your audience this connective tissue to your quant world?
It's interesting. So I was asked to give a presentation at a conference for the Journal of Investment Management, and the topic of the conference was data science, institutional and personal investing. And most of the times I have very quantity papers that have a lot of math in them. I have a number of books and papers that are, written as a physicist was writing a finance paper. So what I did on purpose this time was to focus on the personal investing part and say, recognizing the limitations of what a personal investor is faced with, which is, transactions costs, limited capital, limited information, et cetera, how should one approach investing from a very simple set of rule of thumbs? And what I said, where do I use rule of thumbs myself? Well, I use rule of thumbs myself when I'm doing something, that's intrinsically satisfying for me, and which basically means a hobby. And so I listed my 4 or 5 main hobbies. The first one of them being, what you just said, running very, very long races called ultra marathons. The second one is being a pilot at the commercial and ATP level. Flying everything from small planes to large jets I'm certified for. And then, there's a couple of others, like screenwriting and, physics, which has become more of a hobby now. It was once a profession. I said, what are the commonalities between all these things that I do? And how can I use that to enlighten investing? And the first and the most important thing that I came out with was that you really need to know about your portfolio structure. How do you construct a portfolio where you don't need to go in and out of it all the time? So you construct a portfolio in a nice, simple way that makes sense. And the 2 essential elements there, the first one is you want to generally be with the trend. You want to be in the direction that the market is moving in. And secondly, you don't want to take too many negative carry positions, or a corollary is you want to maximize the positive carry to the degree you're not levering your portfolio, which most personal investors don't lever their portfolio. So you want to maximize in the direction of the trend, and you want to maximize the carry, or minimize the negative carry, so to speak. And then I went into some of the ways my hobbies have similar structural components to them. For example, in ultra running, the most important structural component is you need to watch your pace. You cannot be changing your pace all the time. You cannot speed up a lot in the beginning and then slow down later. When you're flying an airplane, you need to make sure that the trade-off between lift and drag on your airfoil is right, which basically means flying at the right speed. So controlling that speed. And, same thing in physics. There has to do with symmetries. So there's a structure. There's an essential ingredient in every hobby. Another one, screenwriting, for example. If you watch a movie, what you find is that there is an inherent structure to the movie. There's a 17-minute point which tells you what the movie is about. So you take all these things. If you want to invest properly, you want to have the structure of positive trend and generally positive carry. And what you can show, and this reflects back to some of the work that I've done with my colleagues, shows that over the last 50 years where we have data, trend and carry indeed dominate most returns. So that was kind of the most important element of this paper. There's 9 other elements. Some of them have to do with knowing the kind of errors you make and not making them again, and knowing when you're making errors. Also, looking at things like not fighting momentum, which is linked to the first one. So these 10 rules that I've kind of summarized from my own personal activity, I find is something that can be used for most investors as well.
Well, I have to say, I know you did not offer me permission to distribute your paper, but I know my audience would love to see it. So you might have to consider some way to get some of those insights out, or maybe you want to keep them close to the vest. Hey, one idea I wanted to bring up, I got some notes here that I made about it, but do you constantly, and we were talking about your 4 or 5 hobbies, but do you always allow yourself, you're talking about structure, but to think about converting to code?
Yes. Yes, I do. So yeah, I come from a quantitative background, as you know, and I come from a background where my dad and my teachers very, very early in my life instilled, kind of a love for mathematics, and that I held through when I was in, grad school and undergrad and so on. And what I find, and again, this was another one of the hobbies that I listed, is I like to write elegant functional programs. And to me, there's a language called Mathematica that I write my code in. And I think in Mathematica, when I'm thinking about how to implement a rule, I'm actually thinking how those functions are going to look like on a screen. And, I have a laptop with me at all times, and I like to code it and simulate. So another one of the rules that I had put forward in that little paper, and by the way, I'm going to post that paper as soon as I have all the compliance internal approval. That's going to get posted on the website, and I'll send you a link if you want to forward that on to other people. But yes, I think in terms of code, I think in terms of functional code, where you're not spending a lot of time thinking about the mechanics and the syntax, but thinking about, what does this function do? And then how do I wrap it around one function? And one example in my paper is, being able to write a simulation, which I think is absolutely critical to any type of critical thinking, that you can write a simulation in one line. So if you want to test an idea out, you don't have to go out and write, 10,000 lines of code. You can write one line of simulation code, put in your idea and see how that does. And as a matter of fact, sometimes internally when we're discussing the pros and cons of different ideas, we start with the same underlying parameters, meaning a simulation that's controlled. So we know what we're inputting. We know what the world that we've created looks like. And then running our rules on that world. And then changing the parameters, saying if the rules actually are robust to changing the parameters. So it allows you to create like a little sandbox for a quant. And I'm really excited when I'm running those experiments because it's a world that I can control on my computer.
It's funny, in the last couple of weeks, U.S. equities flirting with all-time highs, crossing over at all-time highs. And I think some people just still, even at looking the last 15 years, they'll look at all-time highs today and they'll just assume the rosy scenario. And I like one of the things that in your presentation that you talked about is we as human beings have absolutely no excuse for not imagining a world that we've never seen before. And I think, as you mentioned, simulation, that's the great thing about simulation. But I mean, for me, I'm always thinking, what we look at today, what we think we know about the markets today can radically change. It can just, if you look at a simple example like the Nikkei peaking in 1989 and then looking at the Nikkei since 1989, things don't have to go in the tried and true way, do they?
Exactly. No, they don't. And the world can change. It has, sharp shocks. That was one of the points in the list of 10 was, look generally for scaling rules, meaning, how do things change as you increase your size or increase your position? But then be careful about those sudden, sharp transitions that can happen. And if you're in the world of Black-Scholes, or Brownian motion, you're never going to get these sharp transitions, like we've seen numerous times. But you can imagine them. You can imagine them, and in your simulation, you can build them, and you can see how do your rules do in those sharp transitions. And that's exactly to your point, is that we don't really know how the world will actually evolve, but we have access to technology that lets you imagine all the possibilities on how it evolves, and hence control your exposure based on that.
Well, you mentioned too, which I think is a great point, which is not a point that most investors would probably think about, is being distribution aware.
Yes, exactly. That's exactly right. Distribution aware simply means that, in physics, there's a saying, and a lot of your audience and other speakers that I've heard, are physicists as well. And there's a saying, one of my old professors, when I was at Caltech, he would say, and this is Professor Feynman, he would say, the only thing you need to know is your distribution. If you know what your probability distribution is, you know everything, because then you can calculate anything you want. And that is essentially the problem that we forget, because we assume a distribution, normal distribution, for example, and we start calculating away, and then we expect markets and instruments to act in the way that we have imposed upon it. Well, the world is not normally distributed, as is very well known, and you need to know when that assumption fails. Again, simulation allows you to stress that assumption and change it to a form that is a little bit more conducive to risk management.
We talked early on about PIMCO's core focus and you introducing a new style of thinking, a new trading model. But ultimately, these are all trade-offs. And I mean, it's risk and return. I mean, there's no free lunch. You might be able to find with trend following, and I think it's more than might, you can find a return stream that's perhaps occurring at different times, not typically correlated with other classic types of investments. But that doesn't mean you can't have a drawdown. And on the flip side, I think once again, for the pure equity buy and holders, maybe at all-time highs is not the point in time where you should feel satisfied. You should be looking around and saying, what could go wrong?
Exactly. Yeah, I think that's exactly right. And momentum has its pitfalls as well. So trend following is not a strategy that'll always make money, but trend following is a very natural diversifier against typical buy and hold or typical value, or you name it, typical type of strategy. And in the paper that I've written, I've exhibited using this pictorial cartoon, which is that, normal distribution, the most likely place you are is in the middle of the distribution, and the tails are narrow, and that's the least likelihood by definition, least likely place you're going to be. When you think of a world that can change from one mode to another mode, or one natural habitat to another natural habitat, call it bimodal or multimodal or whatever you want to call it, where things can happen very, very quickly, then the natural place for the market to be, the highest probability place for the market to be, is on one of the tails and not in the middle. And the way you get from one tail to another tail is through trends. So the first one, the normal distribution and mean reversion and value and so on, is a natural theoretical diversifier against trend following, which has to do with momentum dynamics. So if you combine the two, and that's what shows up in carry plus momentum, if you combine the two, the timing is different, the horizon are different. One is more structural, the other one is more tactical. If you combine the two, you have a portfolio that is more robust, and theoretically, and the data shows that it also is. So, for me, having trend following in a portfolio, having a momentum factor exposure in a portfolio is almost essential.
Well, I appreciate you taking the time today. I think that for my audience, I know because I tweeted out your paper, and I know some people have definitely not seen it. It just came out recently this month, if I'm not mistaken. So I think it's you definitely will have some people going, "Ooh, that's really interesting. I thought those guys out there on the coast in Newport Beach were just only conservative, stick to the guns and fixed income." And apparently, there's a rebel in the shop who's doing some interesting quant things. It looks like, huh?
Well, not a Rebel. I'm just trying to expand what PIMCO does really well. I think this firm has a lot of great things it does, and we're encouraged to think outside the box, and we are. And I think we're the first ones who'll say, if it's something that is sustainable and something that makes sense, we will do it. Sometimes it takes a little longer, to come up with things that make sense to us.
Well, I say Rebel with all due compliment. I don't think of Rebel as a bad thing. So
okay.
Hey, listen, is there a place that we can send people for the white paper? Is there a particular link, or just have them Google it?
So it should be hopefully available next week, and it will be most likely at the JOIM conference, www.joim.com. But I will send you the link, and hopefully we'll even post it on the PIMCO website.
Okay, and also the trend following through the rate cycle, the PIMCO paper with your two colleagues, that's available now. They can grab that now.
That's right.
Okay. Hey, listen, I appreciate you taking the time today. Interesting stuff.
Thank you so much. I appreciate you calling me.
Take care. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.